Are you considering an FHA or a conventional loan and really not sure which one or what the differences are? So if you're about to buy a house this year, you definitely want to watch this video. So the main differences between an FHA and a conventional loan are usually the loan amount. So you want to make sure that you check the guidelines for the state or the county that you live in. So FHA and conventional both have different limitations based on the area that you live. Another big difference is the credit score. So FHA started way back in the 1930s after the Great Depression, was really started to bring home ownership to more people. So the credit is a lot more lenient. You can have a bankruptcy or a foreclosure in the last 2 to 3 years and still get a loan. Over on conventional, it's actually 5 years since a bankruptcy and 7 years since a foreclosure. Now, the credit score requirements are different as well. So FHA goes down to 580. There actually are some lenders that might go down into the low 500s on FHA. Conventional, on the other hand, has other requirements. If you're putting a low down payment, conventional really wants you to be in the 700s. The guidelines in writing say 680 if you're doing a low down payment that has mortgage insurance. But in reality, the ones that are getting approved is over 700. Now, if you're putting 20+% down on a conventional loan, you can go all the way down to 620. Another important factor on the conventional versus the FHA loans is the private mortgage insurance. So on a conventional loan, it's called PMI or private mortgage insurance. And it's determined by the percent that you're putting down and your credit score. So it's very, very different. If you have a lower credit score and a lower down payment, your PMI mortgage insurance will be higher. If you have a really high credit score and you're putting a larger down payment, the private mortgage insurance will be lower. So make sure to check with a local lender to make sure you know what your mortgage insurance would be. Now on FHA, it's actually called MIP, which means mortgage insurance premium. So FHA gets mortgage insurance in 2 ways. Number one is it's an increase in the loan amount. So currently it's a 1.75% fee on top of the loan that you're already borrowing. So let's say your loan is $300,000 on a FHA loan. That $300,000 is times by 1.75%, which gives you $5,250. So now that's added to your loan. So your actual loan amount now, after the mortgage insurance is added, is $305,250. In addition, they get a monthly premium. So the current monthly premium, if you're putting less than 10% down, is 0.55%. So that would be calculated by taking your loan amount times 0.55%, and then it's divided by 12. So that's also added to your monthly payment. Now, if you're putting 10+% down, that's reduced to 0.5%. So it's really important when you're talking to your local lender during pre-approval to make sure that you know, am I qualified for FHA? Am I qualified for conventional? Or am I qualified for both? There's some people that meet both requirements. So in that case, you want to compare your FHA loan to your conventional loan side by side and see which one is best for you. Now we're going to get into some other changes. Another big difference is down payment. So FHA has a 3.5% down payment for everybody, as long as you qualify for that payment. So you can be a first-time buyer, a second-time buyer. It actually does not matter with an FHA loan. So it's fantastic because you can get an FHA loan at any time. Now, it's important to note that you can only have one FHA loan at a time. There are some exceptions, and those exceptions are maybe in the case of divorce, you're moving to another state or another area more than 100 miles away from your current house, and then of course you need another loan, you need another house, so that could be an exception. Also, there's exceptions if you co-signed for someone. So if you co-signed for a parent or for a child, and you're needing to buy a loan, then there's also an exception there. So make sure to see, we'll put a link down in the description about some exceptions for when you can have a multiple FHA loan. Now, conventional has a 3% down payment requirement only if you're a first-time buyer. So if you're a multiple-time buyer and if you have owned a property in the last 3 years, you actually are not eligible for the 3% down. So 5% down would be the minimum. Now remember, you have to qualify for the payment with that low down payment percentage. Qualifications are required. But 5% down is the minimum conventional requirement. An additional difference is that FHA loans only apply to primary residences. So it's important to note that FHA does not allow second home or investment properties. What they do allow is if you've got a 2, 3, or 4 unit property and the buyer is living in one of the units, they can actually rent out the others and get rental income. But again, they have to live in one of the units as a primary residence. Now, if you hop over to conventional, you can have anywhere from 1 to 4 units. It can be a condo, it can be a townhouse, it can be a mobile home, and it can be an investment property or a second vacation home as well. So another difference between FHA and conventional is seller credits. So FHA is really, really lenient, and it allows a 6% seller credit on the loan, which is really a large amount. Now, conventional allows 3%. They allow, if you put 10% down or more, it allows 6%. And then if you put a whopping 25% down, you can have a 9% seller credit. Now, you want to make sure to watch our video. We're going to put it here on the title, on the top here. We'll put a link to our video about seller credits and how those are calculated. And you certainly don't want to miss that after you finish watching this video. Hey, if you're liking the video so far, if you're enjoying the channel, please hit the like button. Let me hear your questions, comment, ask us a question. So a final thing that we're going to cover in a big difference between FHA loans and conventional is debt to income ratio. So FHA is really lenient on debt to income ratio. They will allow up to a 55% debt to income ratio. Now we take that by taking your gross income. So both FHA and conventional use your gross income before any taxes are taken out. Now, regarding income, if you're a wage earner, per hour employee or salary W-2, then obviously your gross prior to any tax deductions is taken out. Now, if you're self-employed, we're going to take a 2-year history of your filed tax return income for calculating that gross income. So FHA again has a 55% debt to income ratio. Now, if you hop over to conventional, if you're putting less than 20% down, you should expect that 43 to 45% of your gross income monthly is usually the maximum debt that you can have. Now, that can be extended. We see that up to 49.9, right under 50% if you're putting more than a 20% down payment. Now, all of these rules have exception to what we call automated underwriting. So even though these requirements that I'm talking about might be in writing in the FHA or conventional guidelines, all of them are subject to approval, and they're also subject to what we call automated underwriting. So I'll put another resource in the description below for you about automated underwriting, so you know exactly what that means and how that might apply to you and your pre-approval. So these are our main differences on the differences between FHA and conventional. If you think that you might qualify for both, make sure that your lender is running numbers for both of them. And in some cases, FHA is better, and in some cases, conventional might be better. Hope you got a lot from this video. Please give us a like, share, subscribe. We'll talk to you soon.